Hello, everyone, and welcome to the webinar today. So thrilled that you could make it. We will be covering everything you need to know about passive real estate investing. We have with us two passive investing experts, Adam and Joseph. They are going to go over some of those 101s, but I think also a little bit about taxes. A lot to look forward to. Before we begin, though, I just want to let you all know that we are recording this webinar. You will receive the recording tomorrow via email along with the slides and the speaker's contact so that you can get in touch with them if you need to. We will also be taking questions at the end of the presentation. Feel free to put your questions in the Q&A box at any point, and we will answer them in the order they are received. The Q&A box is definitely where you want to have it, not the chat, because the Q&A allows us to really organize and make sure that we are answering all the questions, and the chat, we don't want it to get lost in there, right? So please put your questions in the Q&A. So briefly, let me just introduce our speakers here. We have Adam Drescher, Investor Relations Manager at Break of Day Capital. Hi, Adam. Thank you for joining.
Good one. Thanks for having us.
Of course. And we also have Joseph Fang. He's the Director of Investor Relations at Break of Day Capital as well. So happy to have you both with us and very excited to hear the presentation.
Well, thank you, Alexander, for that introduction. We're thrilled to be here today. I want to thank the AOA for hosting us. Today, my colleague, Joseph, and myself, we're going to go over Passive Investing 101 to really dig into the benefits of being a passive investor in a multifamily syndication, and to also really go over dig into the deeps about taxes, a lot of the benefits that many people are not even aware of that you benefit from being a passive investor in a multifamily syndication. My colleague, Joe Fang, as you can see here on the left part of the screen, he's our Director of Investor Relations. If you would like to connect with him on LinkedIn, there's a QR code. You can put your phone right up to there and connect with him. His email is joseph@breakofdaycapital.com, and below that is his telephone number. Joe has been an active real estate investor since 2003. He's invested in over 50 commercial real estate syndications. He has been invested in over 6 deals with Break of Day Capital before joining the team in 2022. Prior to joining or just becoming invested in real estate full time, Joe was in the investment management business on Wall Street. He spent 5 years at a hedge fund in New York, and then 7 years with a large institutional fund manager in Los Angeles. And Joe truly loves what he does. He loves conversing with investors of all types, and has a very deep interest in macroeconomics, real estate, alternative investing, such as crypto, and also health. Now, like the previous slide, my QR code is on the left side of the screen if you'd like to connect with me on LinkedIn. I'm the Investor Relations Manager at Break of Day Capital. My email is adam@breakofdaycapital.com, and below that is my telephone number, 602-529-2056. Like Joe, I spent 20 years. I was on Wall Street for over 20 years. I was on the other side of the business, though. While Joe was on the buy side, I was on the sell side, working as institutional sales and sales trader. I covered some of the largest and best performing hedge funds and mutual funds. And right before I joined Break of Day Capital, I was a multifamily realtor and did numerous deals throughout Arizona. And this is what I love doing the most. I really love connecting with individuals and helping them realize their financial objectives through real estate investing. Now, Break of Day Capital, what do we do? What we do is we acquire large underperforming multifamily properties, specifically in high growth markets in the Southwest. And once we do that, we implement repositioning strategies. best-in-class asset management, and we strategize to maximize the value for the shareholders. In 2023, we were recognized by the AOA as the best real estate syndication company of 2022. Inc. magazine recognized us as the 25th fastest growing real estate company in 2023. And in just over 4 years, we've acquired over 1,600 units and have over $280 million in assets under management. Our CEO and operator, Gary Lipsky, he hosts a weekly podcast called the Real Estate Investor Podcast. Joe and myself have both been guests on his podcast. A couple weeks ago, we did one jointly talking about what to look for in an operator. And if you have an iPhone and under podcast, you type in Gary Lipsky, his podcast will show up. And Gary's also an author. He's written a book called Best in Class. And it's an excellent read. I recommend anybody looking to get involved in multifamily to read the book. If you go to our webpage, breakofdaycapital.com, you can order a copy of the book. It's free, just have to pay for shipping. Oops, sorry, let me go back one. So why invest in a multifamily syndication versus being an active investor? I'm going to go over that. As I mentioned, if any questions you have, please answer them in the Q&A box, and we will answer your questions at the end of our webinar. Oops, it's going backwards now. Now, if you are an active investor versus a passive investor, the first big obstacle you have is cost. There is an enormous cost to break in and be an active investor in multifamily. I'll give you an example is right now, most lenders, want you to put at least 40% down the purchase price of your property. And, the last couple of deals I did in Greater Phoenix, both deals were about 8 units. They were purchase price of $1.65 million. So to purchase that property, you need to put $666,000 down. And what I noticed too, just as a realtor, small units versus very large properties, is the smaller properties, the 8 units, the 12 units, even up to 20 units, there's usually not a lot of meat on the bones. There's not a lot of growth potential or ways to really drive the value of the property as much as a much larger property. Now, as a passive investor, you get to invest. If you invest in a syndication, you get to take advantage of the economies of scale. A much larger property usually has just a lot more meat on the bones, a lot more ways to drive the net operating income, to add additional revenue streams, to cut costs. So as a passive investor, you really get to take advantage of these that you don't or will not be able to if you're an active investor in a smaller property. Now, if you're an active investor, something else that will be is a struggle is searching for good deals, financing vendors. So what do we mean by that is a very interesting dynamic about multifamily investing is if you're looking for a single family home, you go to an MLS and there's thousands of choices. And the reason why is there's laws governing that. Once you have a single family home listing, there's laws saying you have to get it to an MLS site in a very short period of time. And they want to get as many eyes on that as possible. That's not the case with multifamily. Most multifamily deals that I was a part of happen off market. Somebody approached me, hey, I'm looking to either buy or sell a property. And then I'd reach out to investors who either own properties that they were looking for or sellers that were looking to sell their property. So there's a big barrier to entry with that you don't really, that you as a new active investor will struggle with. Most of the listings that have been, when somebody's trying to sell a multifamily property, they don't really want it listed. They often get concerned that people are going to say, oh, why is it listed? They couldn't find a buyer. Oh, there must be something wrong with the deal. So that is one thing that you will struggle with as an active investor is trying to find a good multifamily deal. an expert or well-experienced operator gets shown numerous deals well before they hit the market. Because as realtors, one of the worst nightmares of the realtor is you have a great deal and the buyer can't get it done. So realtors, when it comes to a large deal or value deal, are going to show it first to people they know can get deals done. Now, financing too is an interesting hurdle a lot of active investors and new investors will struggle with, because you think it'd be the other way around, but banks would much rather lend to an experienced, CEO and operator who's done deals on a much larger deal than a new investor or new active investor on a smaller deal. So that is one other thing that active investors will struggle with. And also vendors. If you're an active investor, one of the vendors that you'll need to do is have a property management company. Now, normally, I know in Phoenix and Tucson, property management companies charge about 7 to 8% of the gross rents. While you look at a professional operator like Gary Lipsky, who owns we at Break of Day Capital own numerous properties in certain areas, that we've been able to get this cost down significantly to about 3%. So, as a passive investor, you get to take advantage of all this that you normally wouldn't as an active investor. So property maintenance and repairs, all times of day and night. If you are an active investor, anytime an issue arises with a property, you're getting a phone call and you have to deal with it. Sure, you have a property management company, but any cost or repair, they're going to have to run by you. And so anytime there's an issue, a problem with a roof, there's a leak, there's something back up with the plumbing, somebody's not paying rent, you're going to have to deal with it. And one of my good friends who owns several properties in Greater Phoenix will tell you that these phone calls, so there's that I call like the headache factor. These calls that something's wrong with the property, you can almost guarantee just by law of nature, they don't happen at a time that's convenient for you. They happen when you're about to go on vacation, when you're at your kid's baseball game. So that's something an active investor has to deal with. When you're a passive investor in a multifamily syndication, what's great about this is you don't have to deal with any of this. Anytime there's an issue with one of our properties, we get the phone calls. We deal with it. And as I stressed too on the left side of the looking at passive investing, the tenant screening, that's something else that's very important too. When you're dealing with an experienced operator, they know how to, in their company, they know how to screen to avoid issues, with tenants much better than somebody who's, new to the game. And if you own an 8-unit property, just think about it. 2 tenants don't pay rent. That's 25% of your gross income is going to be missing. And that can be, that's huge. While a much larger property, that's obviously not going to be as much of an issue, but we have better checks and balances in place to avoid that. Now, if you're a passive investor in a multifamily syndication, your liability is limited to the amount of money you've invested in the syndication. That's it. So if a black swan event or something terrible happens, that's it. That's the most amount of money you're going to lose is what you invested. That's not the case as an active investor. Your exposure is well beyond not just what you invest in the property or the property's value. It's beyond that. Now, using that $1.65 million property as an example, is let's say your purchase price or the amount you had to put down was $660,000. Your exposure is beyond $666,000. It's beyond that $1.65 million. If you're a passive investor, the amount you've invested, that's it. You're maxed out at that as a limited as a liability. Time. One thing I find most interesting is when you hear about, when billionaires, ultra high net worth individuals talk about their successes, and you ask them, like, what is the most valuable commodity to them? universally, they say time. One story I really think is, I always thought was very interesting to me was, Mark Cuban, love Shark Tank, love watching the show. When he made his first billion plus, when he sold his company in the late 90s, the first thing he did was purchase a private jet. And the reason why he'll tell you is, he realized time is something he could never get back. And while the jet obviously is a huge purchase and it costs a lot to run, he viewed that as, it's much more valuable as time than even the millions of dollars it would cost him to operate that plane. So that's what he did. So that way, even though he's, I believe, located in Texas right now, if he needed to get to New York, he could do that immediately, or LA, Miami, or anywhere he's traveling to, and didn't have to waste his time, checking into an airport, dealing with all the issues that can arise in an airport that we all have dealt with. As a passive investor, that's it. You don't have to deal with any of your time at all when it comes to working with a property. What happens is, if you invest with us, we update you on a monthly basis how the property is doing. We update on a quarterly basis the financial documents, and you can obviously call Joe or myself at any time to find out how the property is doing. But you don't have to deal with this. Is not a time drain on you. A lot of that, if you're an active investor and you think about that, you're a doctor and you have a private practice, or you have a business. If you are an active investor, this is going to take a lot of your time that you probably is not worth losing. Now, I get asked a lot about single family residencies versus multifamily. A lot of people have asked me, where is a better investment? And I will say without hesitation, multifamily is a much better investment. And one of the biggest reasons of all is how a multifamily property is valued versus single family residency. Now, let's say you have a second home that you rent out, and it's doing excellent. You're renting it higher than what anybody else is currently renting their properties for. But when you look to sell, let's say you've checked Zillow, you've checked all those algorithmic valuation models. Your realtor is telling you the property is worth 1.2 million. That's what Zillow says. Well, when you look to sell it, let's say you're ready to put it on the market and you think it's worth 1.2 million. If the property across the street, and let's say it was the exact same square footage, same number of bedrooms, same number of bathrooms, same year built, same condition. If that property across the street sold for $900,000, and then the property just to the east of you, again, same condition, same size, same number of bedrooms, sold for $900,000, and the property behind you sold for $900,000. Well, guess what? Your property is now worth $900,000 because single family residencies are 100% valued on comparable sales. So it would not matter how much you're renting that property for. Now, it's not the case with multifamily. Multifamily properties are based entirely on the net operating income, how much money the property makes after expenses. And a great operator can really drive this number and look for ways to improve it. But doing a comparable to single family residencies, now let's do that same comparison of a multifamily property across the street from yours. Now, let's say you owned a property, 10 units, you think it's worth $2 million. And let's say it makes $100,000 of net operating income. Now, the same property across the street, same year built, same conditions, same number of units. Now, let's say that property sold for $1.5 million. Now, does your property all of a sudden going to be go from what you think is $2 million valuation to $1.5 million valuation? No. What investors are going to look at is how much net operating income that property across the street was making. So if the net operating income for that property was just $75,000, while yours $100,000, investors are going to say, oh yeah, it was making 25% less. So that makes sense that property is worth 1.5 million while yours is worth 2 million. And as I mentioned, net operating income is something a good operator can drive. And with single family, you cannot drive comparable sales. Oops. Now, to sort of tie that all together, when I was talking about a good operator driving net operating income and boosting the value of the property, our most recent acquisition, the property was called the Place of Spanish Trail. We rebranded it to Icon of Spanish Trail. When we were doing the due diligence on this property, one thing that really stuck out to us was the utility bills, the water usage. When we were looking at the books and records, we were wondering what's going on here. We thought there might be something wrong with the plumbing because the water usage was significantly higher. You know, we own properties close by where the water usage was not nearly this high. But when doing the due diligence, looking at the vacant units, one thing that we noticed immediately was the showers, toilets, and faucets were all very high usage. The toilets we're currently using 3.5 gallons per flush. That's what GPF stands for, gallons per flush. And we knew replacing these toilets, we would get this number down to 0.8 gallons per flush. In the showers, we're using 2.5 gallons per minute. That's what GPM stands for, gallons per minute. And replacing them would get this number down to 1.5 gallons per minute. What's great about this was something that we knew would not take too long. You know, once we closed on the property, we order them, we were able to replace the showers, toilets, and faucets all within a week's time. And the hard number that we came up with, this was going to save the property, was $138,000 annually. Now, what would that mean to the valuation of the property? Well, with properties right now in Tucson trading at about a 5% cap rate, net operating income over the value of the property, $138,000 of savings, divide that number by 5%, you get to a value increase of rounded up to $2.8 million. And again, this was an NOI opportunity for us to drive it and really improve on it. And as I mentioned too, you know, larger properties have a lot of meat in their bones, items like this that a good experienced operator can take advantage of. And you can take advantage of as a passive investor, while an active investor, you're putting their money in a much smaller property, will not see this type of improvement at all. And a side note too is as I mentioned, we've done this renovation and we're already seeing, and actually the savings is actually running ahead of this number. We're actually saving the property a lot more of water bills than expected. So this number is actually going to end up being significantly higher. With that, I am going to turn the presentation over to my colleague, Joseph Fang, who's going to talk about a lot of tax benefits that one can experience as a passive investor in a multifamily syndication.
Adam, thank you for that really good high-level overview of the benefits of passive investing. And as you were talking, it unfortunately brought back some bad memories as a former active landlord. So definitely appreciate my lifestyle much better as a passive investor today. So we're going to switch gears a little bit and talk about one of the best things about investing in real estate. Whether you're a direct investor or you're considering investing passively in syndications, the tax benefits, specifically via depreciation, all that stuff will remain and it flows back to you. We talked about, by the way, I should start by saying that none of this is financial advice. Please consult with your CPA or your financial advisor. A lot of the stuff that we're going to be going over the next 10-20 minutes is really based on our own personal experience and kind of just relating some of the conversations that we have with our investors, which may or may not apply to you. Okay. We know that depreciation is one of the best benefits of real estate investing. And you also know that $1 today is worth more than $1 tomorrow, right? So to the extent that you can accelerate depreciation, and the IRS allows us to do that, you know, we want to take advantage of that loophole, right? There's straight line depreciation, there's MACRs, and then there's another one called which you can accelerate depreciation through a cost segregation study. Generally speaking, what a cost segregation study is that we hire an engineer to come into your property, and they will separate out all the different components, and we're able to apply a different depreciation schedule to the various different components, because as you know, things wear out differently, you know, at different times. So by breaking the components into separate categories, we're able to front load more of the depreciation. So not getting more depreciation overall, but we're just going to front load it. We're going to be able to accelerate it. Okay. And so in case you're wondering, if you do this cost segregation study versus you know, doing a straight line depreciation, back of the envelope estimate is probably around 35%, rather, you know, versus 3 to 4% of the total improvements to the property that you can take in year one, which is a lot. Now, in the Jobs Act of 2017, Congress passed this thing called the bonus depreciation, which I'm sure many people, many people on this call probably are aware of. Is that this is a concept that supercharges even further the ability to accelerate depreciation. And what this law says is that, or what this bill says is that, any component of your property that has less than a 20-year depreciation schedule, you can go ahead and take that deduction all upfront in year one. Okay, and this started, you know, a few years ago. It started at 100%. You could take up to 100% of your investment dollars you can write off up to 100% of your investment dollars, and then it gradually decreased over time. So last year in 2023, it got down to 80%. In 2024, it'll be 60, and then it'll be 40 and 20, and so on and so forth. Now, there are talks right now in Congress trying to reinstitute the bonus depreciation back to 100%. So they're trying to make retroactive 2023 back to 100%, and then making this year and the next two years back up to 100% of your investment dollars. So if this is important to you, make sure you keep updated on what's going on. You know, as I mentioned earlier, you know, unlike you know, investing in equities and bonds, one of the best things about real estate is the ability to use depreciation to offset, you know, your capital gains and other sources of income, right? Because at the end of the day, it's really not how much you make, it's how much you get to keep in your pocket that counts. Okay, so ultimately, just as a refresher, you know, depreciation is a non-cash write-off. You're not actually paying for it. The IRS gives us an allowance, you know, to be able to expense. It's a non-cash write-off to offset income, which ultimately reduces our tax burden. So here's an example. Suppose you invested $100,000 in a syndication like ours. In 2024, that bonus depreciation reduced down to 60%, unless Congress passes the bill to bring it back to 100, back up to 100%. But as of right now, $100,000 investment, we could hand you a passive loss of $60,000, which you can then use to offset other passive gains, such as your rental income, capital gains from other syndications, funds, and even interest income from like your savings account, CDs, money market, and even interest payments from bonds if you hold those things. I want to mention that generally speaking, depreciation is a passive loss. So it can't be used to offset active income, such as your W-2 or your 1099 wages. It can only be used to offset other passive income that I mentioned earlier. There is one exception, however, which some of the audience might qualify for, which is that if you are a bona fide real estate professional, and you know, we can talk about this later. What is required to qualify as a rep? Then in that scenario, all of your depreciation can be used to offset all of your income. And here's another tax deferment strategy, a 1031 that I'm sure many of people on this call are aware of. Just as a refresher, you know, when you set up a 1031 to defer taxes from the sale of a property, you would have to use a qualified intermediary to hold on to those funds, right? It cannot go to your account. And then you have various conditions that you need to adhere to, such as identifying the exchange property within a 45-day period from the sale of the property that you're exiting. And then you have to close, you know, within 180 days. So, you know, many of us that have tried to do this, you know, find that it's really stressful. And, you know, the risk here is that, you know, when you're exiting your property, presumably you're selling at a very favorable price, but because you're under the gun to find the exchange property, you have a very limited time to execute on the 1031. There's a risk that you may end up buying a property at a higher valuation than the one you're exiting, right? So that, I mean, this is, I hear this all the time. And then we also probably heard that if you don't spend all of the money, all of the dollars, you know, from the exchange, so you have to replace both the equity and the depreciation, or I'm sorry, and the debt if you have any on there, and whatever you don't spend enough, you know, you're taxed on the remaining, and that's called a boot. So there is this concept called the lazy 1031. I'm not sure who came up with this, but it sounds pretty cool. But this is a way you can still defer taxes when you're exiting out of your property via investing in a syndication where you're still getting tax benefits from the cost segregation and the bonus depreciation that we mentioned in the earlier slides. However, the difference being that you're not under the gun to get this done within 45 or identify the up leg in 45 days and having to close within 180 days. You have the whole entire tax year to identify a suitable property to invest in. Okay, a couple more things, a couple more nuances. Eventually, when you go sell the property, there is a depreciation recapture of up to 25%. So let's say you took $200,000 in depreciation, you would have to potentially pay back up to 25% of that depreciation. Now, keep in mind that even if you did not take depreciation, it is still required by the IRS that you pay the 25% recapture. Now, I do want to mention though, we're getting into the weeds a little bit deeper here, but if you invest in more deals in the future, in deals like ours, you could still take the cost segregation and hopefully the bonus depreciation will still be around 5-10 years from now, but you could still use future depreciation to offset the depreciation recapture on the deal that you're getting out of. Okay. And then one last point, if you cannot use the depreciation today, you don't lose it. It gets carried forward into future years where you do have, incomes that you could depreciate against. Okay, So we spent the last 5-10 minutes talking about the tax benefits, but I also want you to remember that, don't be so focused on tax benefits and ended up investing in a not so good deal or even a bad deal. Okay. Yeah. So I'll give you some examples here. I'm just, this is all from my experience, having invested in over 60 deals and talking to investors all day, all the time, going to conferences and, just exchanging, notes with everybody. But one of the more popular investments outside of real estate is oil and gas drilling, right? And this is very popular because you can write off the depreciation, against income, and there's various depreciation expense that you could take against oil and gas drilling. However, okay, there's a lot of unscrupulous operators, and it's crazy because this is coming from very seasoned passive investors who do a lot of due diligence, and they're finding out years later that investing with really bad operators and basically ended up losing money on their deal. So oil and gas drilling is inherently risky, right? I mean, the engineers can tell you all day that there's oil, but it's not easy to get it out. Okay, so just remember that. And another one that we hear a lot about are ATM funds. Okay. And so we have a lot of friends who are real estate professionals, and this is fantastic. I'm one myself. We get to use all of our depreciation against a variety of income. And Adam alluded to earlier that I also invest in crypto, so there's certainly a lot of gains that can be had from there that can be offset by uh, you know uh, depreciation as a real estate professional. However, there's always a but and a however. ATM machines are not real estate, right? So you cannot use it to offset, uh, even as an active investor, even as a real estate professional, because it's not real estate. Okay, here's another one. And this is again from my own personal experience and talking to different investors, but DSTs, okay, and this is the Delaware Statutory Trusts, not the deferred sales trust, but the DSTs. These are very popular vehicles that can handle or that can accept 1031 exchange money. Be aware that these things have low overall returns, despite the fact that they're easy to get into, and you don't you can defer taxes right away. And so before you invest in DSTs as a way of becoming transitioning from an active to a passive investor and still want to be exposed to a variety of real estate, just make sure you're aware of they call it the 7 deadly sins. And I'm not going to go to every single one of these, but at a very high level, basically these are the limitations that the IRS imposes on DSTs. For example, once you're done with the deal, you cannot raise any more capital. You cannot do a cash out refi or refinance into a lower rate debt. Should the market allow that. You cannot do any kind of improvement to the properties. Earlier, Adam mentioned that one of the things that we get paid for is to drive the value of a property, right? So by making operational improvements, doing renovations, we can increase the net operating income substantially, forcing the appreciation on the properties. And that's how we're able to deliver very strong returns to our investors. You can't really do that in a DST, okay? Furthermore, you cannot acquire more assets in the DST structure. We have a product. It's a multifamily diversified fund. So, in it, we can buy multiple assets so that your dollars are exposed to, they're diversified across several different properties instead of just one. Some of the other things that are kind of unfavorable is that you cannot change the ownership of your investment in the DST. In a syndication, if you want to transfer ownership to a different entity, or you want to transfer to your spouse or your kids, it certainly is possible. I don't think you can do that inside of a DST. And then finally, you're basically stuck with the operator. You know, if they do a bad job, you're gonna have to ride or die with them. Okay, so these are just some of the limitations. So yeah, just in conclusion, you know, these 7 deadly sins, you know, they were designed initially to protect the investors from unscrupulous, you know, aggressive sponsors. But there's a flip side to that, which is that it also limits the sponsor's ability to create value. Okay. And then just to finish off, you know, as we mentioned earlier, in syndications, you know, the name of the game, it really is to create value. So a lot of times, sponsors like ourselves, we don't get paid until the deal exits, right? A lot of the profits are back end loaded because we're generating that net operating income increase. And so the bulk of the returns are coming on the back end. Well, because a DST structure, you can't, the sponsor's hands are basically tied. They can't, there's a lot of stuff that they can't do, right? But in order to stay in business, you know, they have to generate a lot of, or they actually have to impose a lot of fees, you know, at the acquisition level, during the operations, and at a disposition level, because they're the way that DST sponsors are compensated is not really at the exit. It's really during the whole period. And then one other thing, sorry, Adam, before you go to the next page, the other thing that that you should be aware of is that DSTs are sold through broker dealer networks and through RIAs, and so there's usually a commission that needs to be paid to the brokers, and those can be up to 10%. Okay, and that means that on a $100,000 investment, you're only going to have 90% of your capital working for you. And last thing is that just something to be aware of. You know, we're out there scouring for good deals, and in the last, what was it, Adam? Like, we bought one deal in the last 15 months, and so good deals are very hard to come by. And it seems like DST sponsors have a deal ready for your exchange dollars all the time, and I'm just like, you know, unless we're just not very good at what we do, but I don't see how, you know, they can have a good deal all the time, right? So it's just something to think about. And, you know, you can do some math here, right? When you invest in the typical syndication, the expected returns are in excess of 20% per annum. Whereas in the DST structure, you really, you know, expected returns are more like in the 5 to 10% range. You know, just be aware, you know, over a long period of time, compounding at these different rates really makes a huge difference. And with that, let me turn this back over to Adam.
Yes. So concluding here, just want to mention that Break of Day Capital, we have a multifamily impact fund. There's a QR code on the right side of the screen. You can definitely, you know, use your phone and scan that. They'll bring you to it. But it's an excellent opportunity for your, you know, your investment to be diversified across, you know, several multifamily properties. So, you know, we're spreading risk and maximizing returns. One thing else that really stands out, as I mentioned before, you know, what we do is we focus specifically on thriving cities in the Southwest that are benefiting from strong economic growth and excellent demographic trends. And always with multifamily, if you've spoken to me before, you know that the first thing I talk about is Break of Day Capital and Gary Lipsky's track record. Because when you invest in multifamily, you're investing with the operator and their team first, the deal second. Our team is led by Gary Lipsky. I mentioned his history. He's been doing this for over 2 decades. And the most important thing, I believe, with any operator when you invest with them, and the question everybody should ask them, is how much money do you personally have invested in the deal? Gary Lipsky always has significant portion of his capital invest in every deal we did. So he is personally tied to every deal's success. So with that, we're going to turn it over. As we mentioned when we started the webinar, there's a Q&A box. If you have any questions you like Gary and myself to answer, please enter them in the box and we will answer them. But also want to mention as well, as I said before, transparency and accessibility, I believe, are very important things with investor relations. Joseph and myself are here to answer questions and speak more, offline if you'd like to. As I said in the beginning, my email is adam@breakofdaycapital.com. Joseph's is joseph@breakofdaycapital.com. In addition to, I know we mentioned the QR codes, get connected on LinkedIn. I can be reached at 602-529-2056. And with that, Alexander, we're going to turn it over to questions. As I mentioned before, in that Q&A box, you can answer. You can type in the question. We'll get to it.
Absolutely. Yes, we are going to get to questions. I put up a poll question for you all. This is a fantastic opportunity for you to get a complimentary consultation with Adam and Joseph and the team to create a specific plan for your own passive investing journey. It might look a little different for you. So, they obviously have so much experience and can point you in the right direction. I think it's always worth checking out and having a conversation. That way you know all of your options. So I'm going to leave that up for just another minute or two, and we'll go into some of the questions that were asked here. Also, just as a reminder, we did record this, and we are recording it, so we're going to send it to you tomorrow with the slides as well. Also, please put your questions in the question box. If you are putting it in the chat, we may not see it, so I'm going to go through the questions in the question box first. Byron asked at the beginning here, in evaluating the water usage, you gave that example, you get this information from the water authority in the area before you go to active sale?
Well, I think the question is you're asking like, how do we get to this number before we acquire the property? Was as I mentioned, when you're acquiring a multifamily property, during the due diligence period, you see the property's books and records. And one of the books and records always is, the utility expenses. And when we saw this number, as I mentioned, we saw the water usage bill and it was exceptionally high to us. As I said, we own other properties close by. And when Gary first saw this number, he thought there must be something wrong with the plumbing because this number was so high. But when we visited the property, we noticed, as I said, the toilet, showers, and faucets were all high usage. And simply replacing them was going to trim the water bill down significantly. So we estimated how much of a reduction this would be in water usage and how much the electric company charges. And that's how we came up with that hard number of $130,000 the first year. And I think, as I mentioned to you, this number is actually running higher than we expected. One of the things at Break of Day Capital is, we like to say we under promise, over deliver. So that $130,000 number was pretty conservative, and the property is already doing significantly better than that when it comes to water usage savings year to date.
Okay, thanks for explaining that a little further. Byron asked, on an invested property, what is the cash flow you are looking at monthly?
Adam, you want me to take this one?
Yeah, Joseph, why don't you take this one?
Yeah. So every property is going to be a little bit different. Generally speaking, we focus on value add deals. Okay, meaning that we're buying undermanaged, appreciated properties that require some amount of work, to make it performing well again. Okay, and so what happens is when we come in, usually within the first year or two, there's a fair amount of turnover. So we have to be careful balancing between renovating units and then moving tenants from an older unit, a classic unit, a non-renovated unit into one of the newer units. So we don't want to be so aggressive that we're bringing the occupancy down too low. So having said all that, not that the properties are not cash flowing because they have to be cash flowing per the lender requirements, but we don't typically make distributions within the first, 6 to 9 months. We're basically waiting for the property to become more stabilized. And then once we feel comfortable that there's enough built up reserves, then we'll start to issue, or we'll start to make distributions of cash flows. So what you could expect is in year one, that cash flow to investors would be something like low, maybe 2 to 3%. Then it goes up to like 4 or 5% in the second year, and then maybe high single digits, in the third year. And then once we bring the properties to stabilization, we're looking to exit.
Great. Okay. Thanks for explaining that. That makes it very clear. Ken asking, what states in the Southwest are you investing in and what cities?
Go ahead, Adam.
Sure. So we look at the Southwest. So far, all of our deals under Break of Day Capital's umbrella have been in Arizona, specifically in Greater Phoenix and Tucson. However, as I said, we're open. We do look at Nevada, sort of the Vegas market. That's one that we've looked at some deals in very recently. We're also looking at New Mexico, Albuquerque specifically. We're open to Utah, Idaho, Colorado as well. We haven't seen anything that really stuck out. One number that that we really focus on is for us to make an acquisition, we want to be certain that we can boost the net operating income. I talked about a great operator able to drive that number to spike valuation of a property. We're hoping to boost net operating income in a property that we acquire 40% the first year. So we have very strict investment parameters for us to make an acquisition. So, we're open to Southwest. All of our deals have been in Arizona, but we've looked very, deeply at a couple of deals recently in outside of Vegas and also Albuquerque.
Tassif asking, what is the range of investments, minimum and maximum?
Sure, I'll take this one, Joe. The minimum investment right now that we're is $50,000 in either a specific deal or into our fund. We do also have an institutional class investment as well, where if somebody invests $500,000 or more, they will get a slightly better return. But there's as for a maximum, don't have one.
Okay, sky's the limit. Ken
That's one of
asking,
those.
what is the negative, bad downfall with investing in syndications, if any you can think of?
Adam, I'll take this one.
Sure.
Yeah, this is a really good question. I get asked this every day. So in a theoretical sense, it would be something very catastrophic, right? Like if we have a major earthquake or hurricane, which thankfully we don't have that here in Arizona. A more realistic risk would be if we're not able to achieve the rent bumps that we projected, right? So for example, if we think that we can get an additional $300 by renovating the units and somehow, a developer comes across the street and puts in a new Class A property across the street from us, and in a short amount of time increase the supply significantly, that would be be detrimental. Well, maybe that's not the right word, but it would negatively impact our ability to raise rents, and then it might even hurt our occupancy. Okay, so these are the things that we pay a lot of attention to. We like to be in growth areas because in order for you to be able to increase rents, there's got to be a well-diversified job market, and that there's population immigration, there's job growth, and then income growth, and then all that trickles through to ability to pay more rent, right? But on the flip side of that is that a very attractive growth market is also going to, it's also going to be sought out by developers, right? So they're going to come in and add more units. So you got to be careful, where you're buying, even within that, particular MSA, right? Is that good enough? Is that?
Yes, I think that explains it well. We don't have a crystal ball, but you all have
Okay.
done this enough times where you can look at the data and really narrow down where it's going to be less likely to happen, which
And
I think that's really the best you can do, right?
Alexandra, if I may just add one more point,
Sure.
as far as like to me, and again, I gotta take off my GP hat and put on my LP hat. When you basically when you invest in the syndication, you're betting on the operator. Okay, don't worry so much about the deal. Worry about the team that you're betting on first and foremost, because these are highly illiquid assets. You're going to be married to us for 3 to 5 years. You better like us and trust us from day one. Okay. And the way that you assess us, without getting to know us really well, over time, is that you look for stuff like skin in the game. Adam mentioned that earlier, and I think David in the other chat box was asking about what kind of skin in the game we have, right? So you definitely want to see an operator that has more money to lose than you do, right? And that's in excess of acquisition fee and whatever fees that syndicators charge. You want to see that there's real skin in the game, that we're signing on the loan. We have to guarantee these loans in some cases with our own personal assets. Um, you want to look at our track record. You want to look at how we deliver that track record and our expertise. There's a bunch of stuff that you can assess the operator's abilities. And I think Adam, we have that on our website, right? The how do you evaluate operators? And so, the audience should come to our website, and we have a lot of free tools that'll help you evaluate these deals.
Yeah, I'll just add to that, Joe. That's excellent explanation. But yes, we've we did a 3-part webinar series, and one of them was vetting the operator, what to look for. That's available on YouTube. If you just type in Break of Day Capital, vetting the sponsor operator, it should be there. And as before, when we first did the introduction to Break of Day Capital, I mentioned Gary does that weekly podcast. Joe and I were on that podcast as well, talking about the top 10 things to look for in an operator. And one point that Joe touched upon too, that we ranked number one, was making sure the sponsor operator has significant skin in the game.
Yes, I think that says a lot. Really, especially if it's a substantial amount, obviously that makes sense. Lauren's asking, and maybe you all have an answer, what financing is best now, fixed or bridge loans?
Adam, you want me to take this one?
Yes, why don't you take this one?
I'm chuckling because we're Adam and I are working on a webinar for May, and it's the top mythologies that you hear about in multifamily investing, and one of those is the type of loan that you should use to structure a deal, right? So there's everybody has an opinion, everything from variable rate with the rate cap to using fixed rate to using long-term fixed rate to using bridge, right? So these are all tools. We want to have as many tools in our toolbox. It just really depends on the deal. If it's a deal that is a light value add and we think we can get it out, in a couple of years, we're not going to put on a 7-year, agency debt, because the thing that's not often spoken is that some of in commercial real estate, these long-term fixed rate debt, they carry very steep prepayment penalties. I remember during periods of very low interest rate, in late 2000, the teens, 2018, 2019, a lot of sponsors, could not take advantage of a low cap rate environment because they would have to pay $2-3 million in prepayment penalties that really ate significantly into the returns of investors. And so there is no one ideal debt, right? Like, in the last couple of years, rates went up so much, right? It's almost unprecedented how much the Fed raised in such a short amount of time. It's like a 3 standard deviation event. And, even if you had quote unquote long-term fixed rate debt, but if you were unlucky and you put on this debt in 2018 and it's a 5-year fixed rate debt, your debt would be maturing, into a very high or in a high rate environment. And so, you would still be stuck, scrambling to refinance, or either to try to sell the property, which you may not like the price because cap rates have decompressed, or or if you're trying to refinance, you're going to refinance into higher rate debt, right? So I hope that illustrates that there's no one loan product that is ideal.
Very well explained. Nicholas was asking, you mentioned that investors do not have input to add value strategies in a DST, but how do investors have input to value add strategies in a syndication if investments are spread across multiple properties?
You want me to take that, Adam?
Yes, I know.
Yeah, Nicholas, if I'm reading your question correctly, basically, first of all, the truth is that LPs don't really have any operational responsibility, and you're really just entrusting the sponsor, the operating partner, the sponsorship team to do everything and make decision on behalf of everybody. Okay, we will certainly take in your input, but really we're going to be we're going to be flying the plane. You're the passenger. Okay, but where a syndication and a DST is different is that the way that the DST's structured, they're not allowed to do value add. So the things that Adam talked about, where we're renovating units, we're changing out toilets for water savings, that can't be done inside of a DST. It's not allowed by the IRS. Like whatever you buy, that's what you get. Like we want to buy properties in a syndication, in a value add syndication like ours. We want to buy properties that have a lot of meat on the bone, so to speak, right? Because we're going to be able to force the appreciation by something that we're going to do to the property. Like that's what we're getting paid for, is you're paying us to generate value, right? A DST, and it's not that because they're not good or bad sponsors, it's because they're not allowed to do these value add strategies. So they have to buy something that is stabilized, so typically they're probably buying market rate, class A properties that don't have a lot of deferred maintenance, and there's really not much you can do to them. So they're much more subject to the winds of the market. If the wind's blowing at your back, great. But in a tough market, it's probably not going to, it could potentially not make any money or could lose money, right? Whereas the reason why we like our strategy better is because even in a not so favorable market, the fact that we can increase the net operating income to our properties, the property value is still going to go up, even in a bad market. And that's why we like our strategy. And then the second part of your question, as far as I know, I don't think you can buy a DST that has multiple assets in it. Whereas like in a fund, such as one of our syndication funds, we can buy multiple properties over a period of a year or two. So, as far as I know, whatever you start with in a DST, you have to end up with it. Hopefully that answers the question.
Yes, thank you. We did get several of the same question about the rates of return from Charles, Ken, Sam, Ron. So they're all kind of curious as to what's the rate of return you're getting, what's the back end compensation to break of day capital and investors, what are your annual returns to LPs in the last 5 years? So all similar questions here. Any general answer you can give for that?
You want to take that one, Adam?
Sure. Yeah. So when we acquire a property, the last one, Spanish Trail, on our pitch deck, we were targeting to more than double your money in a 3 to 5 year period. The equity multiple on our last Spanish Trail is 2.07 times. So if you were to invest $100,000 with us, we're anticipating, including distributions, the entire amount of money you're going to get back when the property is sold is $207,000. That was our target, our return with Icon at Spanish Trail. with that one. So as I said, it's a 3 to 5 year hold period. We anticipate it being closer to 3 years because this property is in excellent shape to begin with. The renovations aren't going to be down the nuts and bolts like some properties when you acquire them. So the other numbers that people are important to look at is the AAR and the IRR, the average annual return, which does not factor in the time value of money. On our properties, we target 20 to 22%. But again, if the property, it's a 3 year hold period, that number is going to be higher. And the internal rate of return, which factors in the time value of money, and that's an important number right now. We are in an inflationary environment. We're targeting 16 to 18% return on this last deal. But again, if the hold period is 3 years instead of 5, this deal will be the returns will end up being substantially higher. Now, I think the second part of the question was past returns. Well, the 3 deals on a breakaway capital that did go full cycle, we're the first ones to disclose it was the ultimate bull market during that time. The hold period for these 3 properties was anywhere from 18 months to 24 months. The equity multiple averaged 2.24 times. The internal rate of return averaged 61% on those ones. But again, that was a bull market. Don't ever confuse genius for a bull market is one of my favorite quotes. We do have one deal right now that is under contract. With multifamily, until the final dot is signed, it's still under contract to be sold. If the property does sell, the internal rate of return will be in that 18 to 19% range. So that's both our history and what we're anticipating for our next deal.
Yeah, so it seems like according to the market conditions will determine the rate of return and also the holding period, which we also had several questions about. So you had a shorter holding period before in that bull market era. Now you're looking at, is it safe to say closer to 3 to 5 years, or do you have others that are extending beyond that you plan on?
3 to 5 years is our anticipated holding period right now.
Okay, great. And then are there any restrictions if you need to sell your position within the syndication or any withdrawal fees? Those were also came up as well.
Adam, I can take that.
Yeah, I was gonna say, Joe, why don't you take this one since you're-
Yeah. So, as you know, real estate investing is illiquid, right? So when you come in to a syndication, it is expected that you're able to hold your position throughout the investing period, which, as mentioned earlier, you should expect to not be able to touch that money for 3 to 5 years. Now, that does not mean that you're stuck, right? So if for some reason you have an emergency, something, what we can do is you can always approach the sponsor to see if we're in a position to buy back your position, or we may find another investor in the same syndication that may be willing to take your investment. Now, these things do happen. There is the potential to transfer, which is again not possible in the DST. But you may potentially take a small haircut, but it's still possible. Okay. And then I also want to add one more, and we're kind of giving the audience today a little bit of a inside scoop here, but pretty soon we're going to be offering a product where you'll be earning an above average yield, and you can redeem with the 45-day notice. Okay, so this is not very typical in real estate investing, but stay tuned. I think we're probably targeting a launch in May, right? But again, this is a great way for somebody that is unable to commit for 3 to 5 years, that are still looking for above average annual returns, and that's backed by real estate.
That is very exciting. Okay, great. Well, you heard it here first, folks. David asking, based on the rental market today, if you can't increase rents like you thought with the value add, what would be your strategy if that happens?
Let me take that one, Adam.
So why don't you take that one?
Yeah. So again, I mentioned earlier that when you're in this value add strategy in this game, you have to carefully balance between occupancy and pushing rents, right? So it's not a science, it's more of an art. Uh, we push until they push back. Uh, when they push back, we don't push anymore. So if we cannot get the rents that we're expecting, uh, sometimes we will pause renovations so that we're not expending capex dollars and not getting the return that we want on our investment. Um, and in a distress situation, we would actually optimize for occupancy. So we will go up to 100%. We will put more people in a one bedroom unit if necessary, to keep the property, to keep the cash flow, uh, to maintain that cash flow. Um, I've owned and operated multifamily since 2003, so I have very vivid memory experience of going through the great financial crisis, and I know what it takes to be able to operate through distress. And really, you just have to have a lot of reserves, and you just make sure that money keeps coming in. Um, we may have to pause distributions to investors to make sure that we accumulate enough cash flow to protect the asset. Because I think, if you've been in real estate long enough, you'll know that as long as you're not forced to sell at a bad time, you pretty much, I hate to use the word guaranteed, but it's very unlikely to lose money. How's that?
Yeah, I think you're right. It's all about that time frame and adjusting the time frame because eventually the market will cycle as it always does. So we can always trust that, although we may not be able to predict all the exact timing, unfortunately. But yeah, I think it starts obviously with having a strong investment. So Lucia is asking any deals that have not performed or turned out as a loss for investors at this point? Have you ever had that experience? I know maybe not with Break of Day Capital, Joe, but you did mention you've been in this for a long time, so maybe you can share your experience.
Yeah. So as far as and I'll just start with our own performance. So we're not magicians. We are also impacted by market conditions, right? And the fact that the Fed raised interest rates from practically zero, to 5.5% in 16 months, it impacts everybody. Okay. So as far as our performance goes, we've had to pause distributions on a couple of deals where the debt servicing costs just ate up into our cash flow significantly. Um, we fortunately, the way that Gary thinks is that he likes to put on excess reserves on all the major components in the property. So whether we need it or not, and then he also keeps a lot of liquidity at the corporate level. So to the extent that we can backstop these deals, occasionally we'll experience a little negative cash flow situation, but fortunately we haven't had to go out to our investors to ask for more capital, and we're not and luckily we're not under duress of any kind, that unlike some of the other operators that you may or may not have heard of, in the news. Um, my own personal experience investing with 60 syndications, I've actually had some losses. I've had one where we had to take like a 20% loss on capital. Might have one or two. I think we're gonna lose our investment completely, and again, it all boils down to, you know, uh, the operator's expertise, their skin in the game, all that stuff. All of that stuff matters when things don't go right.
Well said, well said. Dee Dee asking, would you ever invest in California, specifically the Bay Area?
Joe, I'm gonna hand that one over to you.
Yeah, this is probably not going to be a popular answer, but I started investing in real estate in Southern California, and we still own, but we have not purchased anything since 2015. Once I was able to discover the world of syndications and being able to go out of state, I much prefer pulling equity, out of our investment properties. Again, that's a tax-free transaction, and taking that money and investing in syndications out of state, not only to diversify, but believe it or not, the return profile on some of these out of state deals are actually better than in California.
I
Uh,
believe it.
not to mention, I don't know how many Californian real estate investors are on the call, but it's just hard, right? Like going from rent control to significant tenant rights. It's just, is it really worth the headache? And I'm just not going to do that anymore for myself.
Mm.
Especially when I've had such a good experience and investing with Gary, and the returns have been great, and so much that I joined the team 2 years ago. So
Yeah, that says it all. Ken asking, does the investor hold title in the properties, a percentage based on the amount invested that they invest, or is the title in the break of day capital name only?
you want me to do this one, Adam?
Yeah, why don't you take this one?
Okay. So rather than holding title directly like you would in a single family home or a apartment building, what it is that we structure an LLC. It's a pass-through entity that owns the asset. So, like for example, the last deal, ours would be like Spanish Trail, LLC, whatever, right? But as a passive investor, you are a member of that LLC, so you have indirect ownership of the property through through being a member of the LLC, and the members are they don't the IRS doesn't really classify you as an owner, but they classify you as a member, so you have rights. Okay, you have monetary rights. Okay, when it comes to your ownership, you do sign. So all of this is done through proper syndication, attorney legal paperwork, and you'll see the private placement memorandum. You'll see the operating agreement, and finally you'll see something called a subscription agreement, and that is where we put down your investment dollars, what percentage of ownership you have in the asset, and then all of the benefits, all the economics, the income, the equity growth, the depreciation, everything that belongs to the property, it all gets passed to the passive investor pro rata.
Thank you for explaining that. David, when does your company get paid in detail in your syndications if investors don't get paid? Do you?
I'll take this one, Adam. So I love this question, and this again is in alignment with the whole skin in the game thing. Okay, a proper syndication, and not everybody structures like this, but this is something good to know, is one where the investors, the LPs, get their capital back first. Okay, and then the operator has to meet a minimum target, and usually that's called a preferred return. A preferred is not a guarantee, but what it is it's a priority given to the investor. Okay, and only after those two conditions have been met do the GP team get to participate in the profit sharing. So I'll give you an example of one of our deals. So like in one of our the class B class, right? So you can get what would happen is whatever profits that we receive from the selling of the property, you'll get back 100% of your money first, and then you're going to accrue a 7% preferred for every year that we hold the property, and then after that the investor gets 70% of the profits.
Great example. I think that helps really paint the picture. Robert was asking, can you use 1031s within the syndication?
I can take that, Adam. So yes, okay. I don't know if you're gonna like the answer though. So when you come in, we can't accept 1031 exchange dollars, but it has to be structured in a TIC, which stands for tenants in common. And with that, you're gonna have to qualify for the loan. You're going to have to help with the qualifying for the net worth and whatever the loan conditions. And you also do not, you also give up the limited liability. So, and then also, you know, it'll have to coincide at a time that we have a deal under contract, right? So this has to really work out, you know, together. Um, so again, you know, you kind of you have to refer back to those conditions that we mentioned earlier with the 1031 exchange, where you know you have the 45 days to identify, you have the 180 days to close. You know, so all of those conditions all have to be met. But let me just remind you that you don't have to force a 1031 exchange. You can still invest in the syndication with non-1031 exchange dollars, because you'll be able to use the cost segregation and the bonus depreciation such that you are potentially able to mitigate all, if not most, of your capital gains from the deal that you're exiting. So please reach out to Adam or myself, and we'll walk you through it. We can go through your numbers. We just actually did that with a couple of our investors, you know, that were trying to, you know, force a 1031, and this worked out really well for them. So, you know, we could talk about that offline.
Yeah, that makes a lot of sense. I mean, if the point is to pay less taxes, there are many ways to accomplish that, not just a 1031 exchange, but the numbers have to make sense. I know next week, just to plug our next webinar, we're going to be talking about trusts and certain trusts that can maybe do that as well, where you're not really restricted to such a short time frame and that you can pull out that money. They are a little more expensive to set up, but if you want that freedom, that's another way to do it potentially. So, I mean, it's all about the numbers and knowing what's right. It's not always a 1031. It's not always a DST. So we definitely need to look at your specific situation. So last question here from Alexa. We sort of covered this, but we'll end here. What are some states that you feel are safer to invest in real estate?
Go ahead, Adam.
So, you know, that's a great question. And, you know, when we've done, talk about operators, you know, one of the really the key things is, you know, how well do they know their local markets? And, you know, as I said, we right now sort of when we look at, you know, markets that we invest in, you know, why do we love Arizona? Why do we love, you know, Phoenix and Tucson so much? Is, you know, one, you know, it's very important that you're investing in a landlord, you know, friendly state. There's a previous question about California, you know, would you invest there? And, you know, that's not a state that we're looking to purchase a multifamily property in, because there's very unfriendly landlord owner rights. Arizona is very landlord friendly. You can evict somebody pretty easily in the state who's not paying rent. And there's also very favorable, you know, tax laws in Arizona that, you know, always the reference I always use about tax laws is, you know, think about, I don't know if any fans of Yellowstone out there, but one of the phenomena that happened in that show is, you know, this ranch that's been the family's owned since the turn of the 19th century. They had basically for free. All of a sudden, you know, the next property over is valued at $100 million, and then their property tax just goes to the roof and they can't afford the property anymore. That does not happen in Arizona and states that we look to invest in. You know, Arizona, there's a cap on how much your property tax can go up every year. It's capped at 5%, and it rarely goes up 5%. So those are some of the things that we look at. And what's also important, you know, that we look at when choosing states to invest in is the economy. One, we want to make sure it's a state that people are moving to versus moving out of. You know, Arizona is the state's been growing in leaps and bounds. I moved here about 8 years ago. It's noticeable how much the state's growing. Same with a state like Nevada or Utah. And we also, it's important too to remember when you're investing, you know, in a city or state, is the economy. And what we mean by that is, you know, one, you want to make sure it's growing, there's good wage growth, but you also want to make sure the economy is diversified. You know, I grew up in New York City, where the economy is, you know, very reliable on the financial service sector. You know, after the financial crisis, values of properties, you know, took a huge dive. So you want to make sure that you're in a place where there's a very good diversified economy. meaning that, for example, Phoenix and Tucson, there once was a time that Phoenix was pretty much retirees and real estate. Now there's a huge, tech presence here. A lot of the semiconductor companies love the arid climate, are buying, investing in giant plants here. There's a lot of financial services jobs now too. And there's also, manufacturing. You have the a lot of healthcare jobs. So that's something else that we look at that's very important too, that you're investing in a city that's not going to take a huge hit if any one sector takes a dive. So factoring that all in, that's why we're kind of focused on the Southwest right now, that we've looked at, obviously our deals have been in Arizona, but we're also looking at places like Nevada. And we'd also look at, as I said, Colorado, Utah, Idaho, and New Mexico is what we're focusing on though. But those are really the key factors that we really need to see for us to to acquire property in a certain city or state.
Great.
Yeah.
Yeah, that makes perfect sense. Go ahead, Joe.
Yeah, sorry, Alexandra. Yeah, I was gonna say, Adam, the other thing too is that the low cost of living or the lower cost of living is also very important. A lot of our 2-bedroom apartments, renovated, they rent out, we're only renting them at like $13.50 a month. It's like that's super affordable, and I our products are, not only are they good inflation hedges, they're also recession resistant, and so we love that we love the space that we play in.
Yeah, I think
Well
Joe, you
said.
touched upon Joe, you touched upon a really good point too that I think is really interesting about multifamily syndication is that these you said recession resistant, which is very key. And we've I know Joe's done as I said, Joe, he loves macroeconomics as much as anybody. I thought I loved him. Joe loves him even more. And one thing that Joe really dug into is like how real estate multifamily is done in times of crisis, and it's actually outperformed all key metrics in tough times. The .com bubble, times like that. So that's something else that we really love about multifamily syndication real estate.
Yeah, fantastic. I think well said. You have a great strategy going. As far as the location of Break a Day, Grace is asking, where are you all located? It sounds like Arizona for you, Adam. But where is the headquarters, or is it sort of remote?
Yeah, we all work remotely. Actually, I think 90% of the team are based here in Arizona, all over Arizona.
Mm.
We have one member in Nevada, and Gary's actually in Manhattan Beach. But the funny thing is, we actually just had our team retreat yesterday, and the funny thing is, like, most of us are not from Arizona, right? Adam's from New York, and I'm a Southern California native, and let's see, Sean is what? He's from all over, but yeah, he's up there in uh Sedona, so we're all, but the thing is that the bulk of the operations is actually on the property, right? And so the way we show our investors how we work is we actually do private tours with investors, potential investors, and we show them, we take them on the property tour like we did yesterday, and they get to meet our property managers and ask them how well we do, right? So then they can see the actual, workings of everything.
That's great. Well, we'll end there on that note. Thank you both so much for going in so much detail on your deals, passive investing, the tax benefits, all of it. Very helpful. Just a reminder, we will be sending the recording to you all tomorrow, along with the PowerPoint slides and the contact information. So you can get in touch if you are interested in looking into passively investing, and hopefully some of you will. Until next time, though, I hope you all have a wonderful day. And thank you, Joe, and thank you so much, both of you, for coming on and talking.
Thank you for having us.
Thank you, Alexander. Thank you for having us.
Of course. Bye, everyone.